you can actually be very profitable if you structure your deals well. So this is one good thing I always tell people: follow the fundamentals of real estate. If the deal will not work, don't beat it. It's not going to work. Leave it. Move on. Go to another deal. Let's say, for example, on this deal, I was able to make everything I said I was going to. So this is the same example, but on this deal, I had a cash flow of 2 million. That means during my 3-year-old period, after paying my lender and the mezzanine debt, I made a cash flow after removing all my operating expenses. That is, from my income, let's say my income was whatever amount, my income was 4 million, my expenses were 2 million. So after I removed my expenses from my income, I made 2 million as my net income. I made 2 million from it. So going by that, this 2 million in the payback category on my capital stack, from this 2 million, I'm going to pay the lender for 3 years, 1.5 million. So this 2 million is a sum of year 1, year 2, year 3. So let's assume I made 2 million year 1, year 2, year 3. I owe my lender approximately 1.5 million. Then my mezzanine debt for the 3-year-old period, I owe them an interest of 336,000. And for my preferred equity partners, I owe them 504,000 for the entire 3 years. And the common equity, I don't know what I owe them yet until we get there. So if I pay from the 2 million cash flow I have, I pay my senior debt 1.5, and I pay the mezzanine debt 3.36, and I pay this 504, the 2 million will not be enough to cover the preferred returns for my preferred equity partners. So look at it. So the 2 million cash flow I made, I've paid the lender 1.5. The mezzanine debt, I've paid 336,000. Then the remaining balance I have from the 2 million is about 161. That means I still owe the preferred equity partners some money, and I don't have it. So I have unpaid 343,000 left. On the sales and proceeds, it means that anytime I decide to exit, this money is not going to go away, but it's going to be deferred. So that's what we call waterfall. I'll explain it better in our next episode. So this 343 will be deferred to whenever I have it, preferably when I sell. That's when I know I can have a large chunk of money. So I will push it to year 3 and decide to pay them. So in year 3, I've sold the property. I sold it for 22 million. I'm paying back the bank their original principal. I'm assuming that this entire thing is interest only. I'm not paying them their principal. I'm just paying them interest only for the entire 3 years. So at the time of sale, it means that 9.1 that the first lender gave to me, I'm paying him back from the 22 million. My mezzanine debt, I owe 1.4. I'm paying them back from the 22 million. After that, now I will move to the equity part of it. Remember, I still owe my preferred equity partners 343. I have to pay that first. After paying that first, also pay them their initial capital. Let's assume they gave me, I don't know what they gave me, maybe from this slide, they gave me 1.4 million. So I'll pay them the 1.4 million plus the 343,000 that I owe them. Sorry, I did not include that here. So, but understand the idea. I'm going to pay them their principal and pay them the preferred returns that I promised to give them. I'm going to pay them off that. Then the remaining proceeds, after I've paid everybody their money, let's assume this is not correct, because if you take off the 1.4 million, you should have about 9,496,000. So the remaining cash flow of my sales, my proceeds, let's say is remaining approximately 9.5 million. That is the money I'm going to split with my LP team and the co-GPs on my team. That's the money I'm going to split with them. So from this analysis I've given to you, yes, the common equity partners, actually, if the property did well and all that, they gain a lot. They gain a lot of money at closing. They gain tax returns. They gain a lot, but it's still the riskiest. It's very, very risky and all that. So I'm now moving forward to the pros and cons. What are the pros and cons of becoming over leveraged? Because you also don't want to be over leveraged. When I mean over leveraged, that means you don't want to carry on so much debt. Although it has some pros, some advantages. If you have so much debt, it gives you some advantages, and at the same time, it gives you some disadvantages. So what are the pros in this category? For the pros, we have increased returns on equity. What that means is that because you're investing little portion of your money in it is small, but you're gaining cash flow, you are gaining maybe preferred equity. If your deal was structured with preferred equity for your LPs, you have your tax returns, you have significant significant ownership on that property. If you do have it, that is one of the pros of structuring your deal in this form. Another pro of doing this is tax benefit. So for every debt or every loan or every interest you pay back, there's something that they give you at the end of the year. I don't know how many of you have taken note of it. They call it returns on interest paid. So the bank will issue you every year. They give you a total of the interest that you've paid on the loan you took from them, and you use that returns to write off your taxes. So if you've not been collecting that from your lender, or maybe they've been sending it to you and you've not been using it, then you are losing money, because that interest paid, I've forgotten the name, but the idea is that amount of interest you've paid, the lender will issue you a form and you can use it. Thank you. 1098 mortgage interest statement. That is it. So they issue you that if you are paying a lot of interest, like that is, you are paying the senior debt lender, you are paying the mezzanine, you are paying your preferred equity partners, all those things can be write-offs for you and reduce your tax liabilities. So that is one benefit of being over leveraged. Another one is capital efficiency. That means you can use your money. Let's say I have 10 million. I can decide that since I've gotten capital from other sources, my remaining 9 million, I can decide to use it to do other deals because I have a deal funded by other people's money at this point. So it will release your cash to do other investments, other projects. This is one benefit of taking on more leverage and all that. Then inflation. In this category, it will help you hedge inflation, especially for debts that are fixed. So if you have a fixed debt, regardless of if the property rent went up or whatever thing happened, maybe inflation went up and things have really gone bad, you'll still be paying the same interest rate because it's fixed. So that is one pros of having more leverage at that time. So what are the cons of having more leverage? I think because of the cons, I'm not going to even advise you to be over leveraged. So one of the cons of being over leveraged is higher risk default. So for example, if your property did not perform very well, maybe due to many factors, your property manager was not performing well, or the economy just did not do well, you have high vacancies, your income was low and all that, so you're not able to bring out a lot of cash flow. If that happens to you, that means you might be at default. That means you might not be able to service those liabilities you've taken on from those lenders. Because there are so many, you might be prone to default. So you need to be very careful when you're taking up so much leverage. Exposure to interest rate risk. So for example, some of these categories, they are not fixed. Some of them are floating rates. You might have a mezzanine that says, I don't want to give you fixed, it's floating. Or you might have a preferred equity partner that gives you one kind of very funny structure. And if that happens, imagine how the Fed was increasing the interest rate. People that had a floating rate of 3%, they now had 9% and all that. If that happens to you, then you are in deep trouble. You don't want to allow that happen to you. So it exposes you to risk interest rates when you have a floating rate. Then reduce flexibility. You will not be able to do so many things. Like if you have some capital projects to execute and maybe you did not raise the money at closing, you're banking on the income after paying your lenders to run those projects. You might not have that flexibility of any income to do the project because you don't have money and all that, because your debt has taken up your entire cash flow. Then potential for negative equity. So let me explain this. I'm going to really narrow down into this because this is the reality of what is happening in this market. So I'm going to take us back a little. In 2022, we found out that properties went very high because interest rate was low. People were buying properties at outrageous prices for what they were not worth. So properties that were actually worth 9 million, we saw people buying it for 20 million. Crazy, right? This is reality. It happened. People bought property way above its value. So now the Fed decided, I'm going to beat down inflation. And one of my two is I'm going to increase the interest rate. So the Fed decided to start increasing interest rate and increased it 13 times. And because they did that, interest rate went up, and interest rate has some effect on cap rate. When interest rate goes up, cap rate goes up as well. When the cap rate is going up, that means you are losing value. That means your property that was worth 10 million might actually become 14 million because the cap rate has gone up. And that's not what you want. And that happened. That really happened to so many properties. So we found some people that bought their property for 20 million because the cap rate went up. This time around, the property was now worth 13 million. So they've lost about 7 million because of the cap rate. And doing that, they will not be able to exit from that property. Rather, they have to sell and, if possible, bring out of pocket to pay the difference to the bank. We saw this happening and it's still happening. Some of them were over leveraged. They had a first position, they had a preferred equity partner, different things. different structure, and they bought it for the most outrageous prices. So this is one good thing I always tell people: follow the fundamentals of real estate. If the deal will not work, don't beat it. It's not going to work. Leave it. Move on. Go to another deal. It takes us months, years to get one deal. Like, we're currently under contract on a deal, and it took us more than 10 months to get that deal. The deal we did last year took me a year to get one deal. So if it's not penciling out, don't be emotionally attracted to it, because these are the implications. You will find out that you become negative, you have a negative equity. So a property that you bought for 9 million, for 20 million, now becomes what? 9 million. How are you going to pay the difference? How are you going to pay your lenders? How are you going to pay your preferred equity partners? They will come after you. So imagine if you were the guarantor to those debts, then you're in trouble. They will not only come after you, they will go after your properties. That is for the bank. So if you have a recourse loan, then it's not limited to the property that is going to be foreclosed. Your own properties will also be foreclosed. So, but if you have a non-recourse loan, then limited to the property that is being foreclosed. So you just need to be very careful and follow the fundamentals. Don't allow anything just derail you and say because you want a deal, you take on different types of equity and all that. You need to itemize it and see the risk and the effect and all that. So in summary, before I end this presentation, I'm going to just summarize by saying that the understanding of this will help you structure your deal. You can actually be very profitable if you structure your deals well. When you add preferred equity to a deal, you find out that your deal, the returns becomes better for your investors. The negative part of it, that it affects your cash flow. So your cash flow might be affected because you are paying out preferred returns to your investor. In other words, it has affected you indirectly. That means you might not have cash flow. But for me, the way I've mitigated the risk so that it doesn't affect, because that will most times affect the GPs. The way I've decided for it not to affect me, since I'm paying my investors, the limited partners or whoever I'm taking that from, preferred returns, I've decided to invest also as a limited partner. So whatever guaranteed preferred returns they are having, I'm going to take advantage of it as a GP member. So that is the way I have chosen to mitigate the risk of not having cash flow for the entire deal. So next week, we'll be going through more complex example. That is when we have two preferred equity. That means we're giving our LP pref. We're also giving a preferred equity partner pref. And we have a 70-30 split. I'm going to give us this example, and we're going to see a scenario and work on it, and we'll see the implication of what this will look like at the end of the day. Then also I'm going to define waterfall definition and how you can allocate it. I'm going to show you how it presents itself on a deal. So I'm not paying you this year because I didn't make money. Where does it appear? When will I pay you that money? When will I have that money to pay? So I'm going to explain what waterfall is and the implication of it. Then I'm also going to do a practical example of a GP split. What I did was theory. I'm going to do a GP split. Let's say we made 500. This is how much BB is getting, this is how much Jack is getting, this is how much JC is getting, and all that. So next week is more of practical on a deal, so that we can understand it and go and implement it to our several deals.